Imagine setting aside $250 every month. After 2 years, that's $6,000 sitting in your account. What is that money actually doing for you? Nothing. Now imagine the same $6,000 could grow more than 5 times bigger with zero extra effort on your part. That's exactly what we're breaking down today. And $250 a month really isn't a big ask. It's roughly what a slightly too generous weekend can cost you without you even noticing. Dinner out, a few drinks, a couple of impulse buys. The only difference here is that instead of watching it disappear, you set it aside. Do that every month for 2 years without changing anything else in your life. And that's exactly how you end up with $6,000 just sitting there. Quick note before we go further, I'm not a financial advisor, so I'm not going to tell you which exact product to buy. My goal here is to walk you through the mechanics, so you can make your own informed decision afterward. The numbers below are based on real historical data, not a promise of future results. Let's go back to our $6,000. If you leave it in a regular savings account, earning 1% a year, after 20 years you'd have about $7,300. In 20 years, you'd have earned barely $1,300. Now look at what happens if, instead of letting that money sit there, you put it into investments with an average return of 10% a year over the same 20 years. You'd end up with around $40,000. Same starting point, same $6,000, but a different decision, and the end result is more than 5 times higher. Where does that 10% come from? I didn't pick it at random to get a clean round number. I looked at the actual average of the U.S. stock market across several major historical periods since 1871, since 1928, since 1957, and over the last 100 years up to today. The average across all those periods comes out to roughly 10.3% a year. I'm rounding it to 10% for the rest of the video, just to keep the math easy to follow. You'll find all my sources in the description if you want to check for yourself. And that's the real point. The biggest wealth gap isn't usually between people who spend and people who save. It's between people who save and people who invest. If it's this obvious on paper, why do so few people make the leap? Because the reason isn't mathematical, it's psychological. Saving gives you a feeling of control. You see the number, it doesn't move, it never drops on some random Tuesday without warning. Investing, on the other hand, moves. Sometimes up, sometimes down. And that instability, even when it's perfectly normal, is enough to scare a lot of people away. And you, with that $6,000 we just imagined together, what would you actually do? Leave it where it is for safety, or would you be tempted to move it? Let me know in the comments. I'm genuinely curious where you stand. It's completely normal not to want to risk what took time to build, and that's exactly why the shift shouldn't happen all at once, but in stages. Before putting a single dollar into investments, you should first have a safety cushion. 3 to 6 months of living expenses kept in cash, untouched. This money isn't meant to grow. It's there to absorb shocks, a job loss, a medical emergency, a car repair that hits at the worst possible time. The number one reason people panic sell their investments is that they need cash too quickly, at the worst moment, often right in the middle of a market downturn. That safety cushion is what protects your investments from your own life. Never mentally mix your safety money with your growth money. Think of it as 2 separate drawers. The first is the "this never moves" drawer. The second is the "this is allowed to move" because that's literally its job drawer. The day you accept that the second drawer fluctuates, the anxiety around investing drops dramatically. You just saw it with only $250 a month. The cost of a slightly too expensive weekend, you can build up $6,000 in 2 years. That's exactly what starting small looks like. You don't need thousands of dollars up front, just a simple amount repeated month after month. In the beginning, the goal isn't to generate spectacular gains. The goal is to build a reflex, and that reflex will end up mattering far more than the moment you started. This is the classic beginner mistake, jumping straight into complicated strategies, short-term trading, leveraged products, bets on volatile cryptocurrencies. Yet in the vast majority of cases, simpler approaches outperform more sophisticated ones over the long run. A good example: funds that track a broad stock market index. Instead of trying to guess which company is about to take off, you automatically own a small piece of hundreds of companies at once. Diversification, lower risk, steady growth over time. Here's where everything clicks into place. You saw that your $6,000, simply invested and left alone for 20 years, becomes about $40,000. Now imagine you don't stop after those first 2 years. Imagine you keep putting in that same $250 a month for the next 20 years on top of letting your initial capital keep growing. Result? Around $212,000. And here's the detail that changes everything. Out of that total, you'll have only put in $66,000 of your own money. The rest, more than $145,000, comes purely from the growth of your money over time. That's the snowball effect of compound interest, working for you while you're busy doing other things. But there's a psychological trap here. Investing feels uncomfortable at first. Markets drop, headlines get dramatic, and the urge to pull everything out gets strong. That's exactly the moment where discipline separates someone who invests from someone who gambles. An image that helps: keeping eggs in your fridge is static. They don't transform, they don't multiply, and over time they actually start to spoil. Investing is more like buying a hen. It takes a bit of attention up front, but after that it keeps laying eggs again and again without you having to think about it every day. And honestly, I'll be straight with you. I myself left money sitting in an account for several years, simply out of fear of getting it wrong by investing. Looking back, that fear cost me far more than any market drop ever could have. A fair question, and you're not the only one asking it. What if I start investing and the market drops right after? Market downturns aren't an anomaly. They've always been part of the game. When you invest consistently, a market drop lets you buy more shares at the same monthly price, which often works in your favor once the market returns to its normal trajectory. That's why experienced investors stay calm during turbulent periods. They're not thinking in days, they're thinking in decades. Before wrapping up, I want to name 3 sentences almost everyone tells themselves at some point. If you recognize yourself in one of them, that's okay. That's exactly the point of this part. Mistake 1. I'm waiting until I have more money. You just saw that you can start with $250 a month. Waiting to have more often looks like procrastination dressed up as caution. And the problem isn't just the money you're not investing while you wait, it's the time you're losing. And time, as we've seen, is what does most of the heavy lifting. Mistake 2. I'm waiting for the right moment. The problem with this sentence is that there's never a perfect moment. There's always a reason to hesitate: an election, a crisis, shifting interest rates, talk of a recession. People who wait for a clear signal to get started often end up waiting indefinitely. As we saw earlier, downturns have always been part of the game. They're not a signal to stay on the sidelines. Mistake 3. I'm afraid of losing money. This fear is legitimate, but it often confuses 2 different things: short-term risk and long-term risk. Over a single year, yes, the market can lose value, but over 20 years, the real risk isn't volatility, it's leaving your money frozen for decades. You saw it at the start of this video. Doing nothing has a cost too. It's just invisible because it never drops, it just also never climbs. To sum up the path: first, Build a safety cushion of 3 to 6 months of expenses. Mentally split your money in two. Safety on one side, growth on the other. Start investing small, but consistently, even $250 a month is enough to begin. Favor simple, diversified, long-term approaches. Stay consistent and let time do most of the heavy lifting. Here's the truth most people eventually learn, often a bit too late. Saving gives you stability, but investing gives you freedom. If you want to start turning this into concrete action, here's broadly where most people begin. Look into the types of investment accounts available in your country and compare their pros and cons. Learn what an index fund actually is, how it works, and what options exist. Think about a monthly amount you could set aside without putting your financial security at risk, even a symbolic amount to start. Before making any decision, cross-check multiple reliable sources, and if you feel you need to, talk to a qualified professional about your specific situation. I'm deliberately staying general here because your situation, your country, and your goals are different from mine. This video is meant to be educational and precautionary, to help you understand the mechanics, not to tell you what to do with your money. I'm not a financial advisor. Nothing in this video constitutes personalized advice, and past performance never guarantees future results. Always do your own research before acting. So where are you today? Still in the saving phase? Already investing? Or a bit of both? Tell me in the comments what's held you back so far, or on the other hand, what helped you take the leap.